What up, YouTube? Anyone who has watched my channel knows that I am a fan of put credit spreads. So today I want to really hit home. I really want to paint the picture for you to show you why put credit spreads are a good start to creating the ultimate side hustle. So I love options trading. And I really like put credit spreads, and I will explain why in this video, so stick with me. So I'm just gonna pick a random stock that I was looking at the other day, Rivian, ticker symbol RIVN. So Rivian, as many of you know, is a competitor to Tesla. They're an EV car company that had significant backing by Amazon, and they actually make the Amazon delivery, those delivery vans that you see everywhere. So, and I've got my notes here on my iPad. So if you see me glance down at them, that's what I'm doing. I can't keep all these numbers straight without some sort of notes in front of me. So Rivian is selling at about $13.07 a share right now. So the company is, the market cap of the company, meaning the value of all the equity in the company, is about $15 billion right now, which pales in comparison with Tesla. So I actually think that Rivian could be a good long-term play if it's like a close second in the EV market. I mean, it seems popular. I see Rivians all over the town now, on the road. It seems like a lot of people are maybe preferring them to Tesla, and definitely preferring the design to the Tesla Cybertruck. So let's assume we did the homework. We think Rivian is a good stock. We wouldn't mind owning it. And my rule for selling put credit spreads is you don't want to do this on stocks that you wouldn't mind owning for the long term. Okay, so assuming that checkbox is checked, what we can do when we sell a put credit spread, what we're doing is we are insuring the stock. Now, if we were purely just insuring the stock, it's actually not called a put credit spread. It's called a cash secured put. So what I would do is I would sell the $13 strike put. If I did that, and I did that for the option expiring 30 days from now, approximately, so on August 1st, actually less than 30 days from now, like 28 or something like that, I would get $67. So I could sell, at least as of market close, the last closing session when the stock was at $13.07, if I was willing to insure the stock. So that's what you're doing when you sell a put, is you're insuring the stock. You're insuring Mr. Market and saying, hey, if the stock falls below $13 a share, I will buy it from you at $13 a share. So if it goes down to $10 a share, I will still buy it at $13 a share anytime between now and when the option expires 30 days from now. So I would get $67 for that. And my broker is going to require me to pony up $1,300 because I need that much. It costs $1,300 if I'm going to buy 100 shares from Mr. Market at $13 a share, right? Are you following me? So $67 is what I will make as long as the share price on expiration 30 days from now is above $13 a share. I pocket that $67, and technically I pocket that $67 no matter what. That's the insurance premium that Mr. Market pays me, and I never have to refund it. Now, if the stock goes down enough, I'm gonna take some losses. So that's about a 5% return. $67 on $1,300. That's about a 5% return on my capital at risk, which is great. In 1 month time, 5%. If I could do this 10 months of the year, that's 50% return on that $1,300. And that's, if I could do $67 10 times a year, that's $670 a year on that $1,300, which is, you know, about a 50% return, which is phenomenal, right? And then imagine, I mean, sometimes when I just give you an example of doing this with one contract, it may not seem like much, like I don't care about an extra $67 a month. Now, let's say you're dealing with a bit bigger portfolio, so you can do 10 of these at a time. So instead of collecting $67, you collect $670, okay, on 13,000, right? So $670 a month. That starts to be more meaningful. That's like it's like a car payment, right? Speaking of which, so I'm parked here in my car. I'm in my one car, my larger car, because I have this little SUV that I rent out on Turo, and somebody came and just picked it up, so I was meeting them to give them the keys. And I view put credit spreads, this business, it is a business. I'm in the insurance business, I'm insuring stock. I view it similar to doing something like Turo. You've got an asset. In the case of Turo, it's a car, and you're making monthly income off of that car, right? Here with stock is my asset. I am insuring stock and collecting monthly income, right? And $13,000 is is cheaper than the cost of a car. So for cheaper than the cost of a car, if you had $13,000, you could do this month in, month out, and generate your $670 a month on 10 contracts, right? Now, that's cash secured puts. I was telling you I'm going to talk about put credit spreads, which I love. I like it even more than cash secured puts, and this is why. With put credit spreads, what you're doing is you're still selling that same $13 strike put, but you're buying insurance. I call it reinsurance. You're buying reinsurance for your business. So I will sell that $13 put. I am insuring Mr. Market against losses below $13 a share, but then I'll buy my own insurance at, let's say, $11. So at the $11, I will buy the $11 strike put, okay? That also expires at the same time. And for that, I will have to pay $11, okay? Each contract costs me $11. So I get $67 from Mr. Market. That's the insurance premium he pays. I pay $11 of insurance premium to buy reinsurance from somebody else in the market. The net of that 67 minus 11 is 56. So I will have $56 remaining once I do this. So I can basically do the $13, $11 put credit spread, and I will collect $56. And my risk there is actually only the width of the spread times 100. So my risk is $200. So I risk $200 of capital. That's all I have to have in my brokerage account to do this. So if you say, I don't have enough funds to get started, that's a bunch of BS. You do. You could start with these small ones. I collect $56 off my 200. That is a 28% return over that 30-day period. Okay. Now, again, maybe $56 doesn't seem like a lot to you. I'm just illustrating with one contract. Again, you could do 10 contracts, let's say. So you would have to have $2,000, which would be at risk, instead of 200. So you got to multiply everything by 10 if we're talking 10 contracts. And you could collect $560 for this 1 month period, right? Which is similar to like a car payment, or, pay for your flight to that round trip flight to somewhere that you want to go next month, right? Or what I do is I like to roll the money, these premiums, the profit that I get from these trades back into my account, so that I can grow my account and do even more of these trades, right? Because I'm building a real business. Anybody tells you it's not a real business, they don't understand. You are building a real business. I think this is the easiest business to start. You don't need to advertise. You don't need to find customers. You don't need to do any of that. And you can make real money. So you could make 560 bucks on these 10 contracts. You're risking 2,000. Now, yes, there is always risk. I mean, if Rivian goes down to $11 a share, you could lose all $2,000. That is a risk that you're taking. So you want to look at technical analysis. You want to look at, which is charts, to kind of see where the support levels are, where people in the market have been buying the stock if it dips, because it's also likely to bounce at that area. You want to do all that due diligence, okay? And so this video is not intended to be a comprehensive lesson on that. So I just launched a book. It just went live. I took a lot of time writing this book because I'm really passionate about this topic, and I really do believe it's the ultimate side hustle, and not a lot of people understand it, know about it, and I feel like it's something that needs to be talked about. So I wrote this book. It's called Building Berkshire. I'm a big Berkshire Hathaway fan, big Warren Buffett fan. I grew up reading about his methodology, his investing style, and that's kind of how I've modeled my own investing style. So I'll put a link in the description to my book. I think I have like a 4th of July. There's a 4th of July sale on Amazon where actually, if you see this video before July 8th, you can get the book for free on Kindle. After that, it's not going to be much. The most it will cost you is 10 bucks, which is the cost of one of those fancy drinks at one of those fancy drink places these days, right? So 10 bucks to learn something that could feed you for a lifetime, I don't think is too much. I tried to make it just accessible to anybody, doesn't matter your circumstances, right? So pick up my book. You'll learn more details. You'll learn more about the put credit spread. And in that book, I explain what happens if you do this in a month where the stock tanks. And that's why I like put credit spreads too, because it does limit your downside. Instead of losing potentially the 13,000 if you did this as a cash secured put, you're only losing 2,000, right? And in a lot of cases, we cut our losses short before it even gets to that max loss. We maybe cut it when it's about half that, okay? And what you're going to find in that book is that there are, I actually like it. When I really want to accumulate a long position in a stock, let's say I really like Rivian and I really want to create a big position in it, I actually secretly kind of hope that my put credit spread loses money, because on my other trading strategies that I talk about in the book, call debit spreads and leaps options, I will make way more money on a rebound of the stock, and I get to buy it in at a lower price, at a better valuation. I would make way more money over the long term if when it bounces back than I lost on my put credit spread. So I don't care so much if I lose on the put credit spread, because I know there's strategies if I'm really passionate about this company and I think it's a really good investment. As the stock goes back up, I will more than make up for it. So I hope this was helpful to you. I hope you liked the video. If you do, like and subscribe. It'll encourage me to put out more content like this. When I see people watching, it does motivate me to create more of these. I will see you in the next one.